Welcome. Let's see here. We're missing
let's get this guy in here.
Got him in there. Hey guys, welcome. It's Live at 5. My name is Jeb Smith. We have Josh Lewis here. I am a real estate broker, and Josh is a mortgage lender. For those of you who don't know, we are here to answer your mortgage and real estate related questions, help guide you through this crazy housing market that we've experienced over the last 18 months or so. And going forward, the title of the video, the 2022 housing market may surprise you. We're going to talk about kind of expectations over the next couple of months, what you're likely to see. We're going to talk about current events. More importantly, we're going to answer your questions. So put those in the description, or in the description, in the comment section below, and we'll get to them. Josh, welcome back. We were out last week. We're back now. How are you, my friend?
Slowly recovering. We get to do copious amounts of stretching throughout the day. For those of you who weren't watching earlier,
bro, I haven't seen you stretch once.
Well, I closed the door. I don't want to subject you to the beauty that is me doing yoga movements and whatnot.
Bro, if I find out that's going to happen, we're going to live stream this thing real quick.
Take you to 1 million subscribers
live at noon.
Yeah.
Anyway, so we got some updates on conventional loan limits over the last 10 days or so. Hell, everybody in the world has put a video out on it. And so let's talk about conventional loan limits, and then that'll lead us into maybe talking about currently where we are in the housing market.
Yeah, and we had talked about this a few months ago. A couple of lenders, I believe it was PennyMac was the one that started it. It's pretty easy to reverse engineer the numbers that the government uses for setting conforming loan limits. So a few of them looked back a few months ago, looked forward a few months ago, and said, it's going to be at least $625. So we'll start doing $625,000 loan amounts anywhere in the United States. Well, we get to see the official numbers. It actually came in hotter than that. So we're at 647,200 for the coming year. And if you're in a high balance area, you can go all the way. What is our monstrous number? $970,800. So close to $1 million on that. And if you read the Wall Street Journal, New York Times, any other financial press, you've probably seen a crazy headline about how the government is supporting another housing bubble by buying loans all the way up to $1 million, which is a little bit silly. The reason why the government does this is in the areas that they offer high balance loans, home prices are absurdly high. So if you're in an area in the middle of America and the average home price is $300,000, you don't need a high balance loan because someone moderate means can easily afford a home. We're here in Orange County. We talk about this every week. If you want to own a home in Orange County, you're looking at, what would you say, Jeb, single family? Cheapest community is about 700 now?
I mean, I just sold one in Santa Ana. It was a 2-bedroom, 1 bath, 1,300 square feet, sold for 640. I mean, to give you an idea, and most people are thinking 2 bedrooms, 1 bath. What the hell am I going to do with that? Exactly. The majority of people out there aren't looking for homes that size, but I would say your average 3.2. And when I say average property, nothing extravagant about the property. Basic 6,000 or so square foot lot. 1,100 square feet, at least 750 in Orange County. Here in Huntington Beach, you're probably talking 859 at this point.
Yeah, and put it into context. So what does this do? What does a loan amount in Orange County that goes up to $970,000 do for average people? This isn't about helping wealthy people buy $1 million homes. If you're in a community where an entry-level home is $850,000 and you're in an area that doesn't have high balance loans, what that means is you're looking at jumbo financing, and you're probably looking at a minimum of 10% down, meaning $85,000 down payment, versus when Fannie Mae does a high balance loan, your minimum is 5% down, so $40,000. It makes it where someone who is really a middle income family can afford to buy homes in these high cost areas. So what I was going to share here, let's actually show the map. The map is interesting here. So here's our conforming limit. So all of these gray areas essentially are your 670,200 loan limit. The colored areas, the dark orange ones here, so here we are, LA County, 970,800. And then you look in these lighter colors, orange is a little bit lower. So San Diego is an example here. 879, 750. I'm kind of stunned, Jeb.
Yeah,
We've talked on the
agreed.
show. We've
Yep.
talked on the show here for weeks that San Diego's gone nuts, and their prices are very similar to Orange and LA counties now. And the government, in their infinite wisdom, runs their median home price calculation and says 879, 750 is all they get. But it's close enough to the 970 that most people that need it can benefit from it. The interesting part to me about this is we've got 3 communities up in the state of Washington that now have high balance loans. We've got little pockets here of Idaho, a pocket in Wyoming. It's Jackson Hole, basically.
Look at Tennessee. I mean, I'm looking at Tennessee, probably around the Nashville, Franklin area, right? I mean,
Yep.
It's got to be it. Yeah.
Yep. And so it was always this Southern California Bay Area. You had a little bit around New York, New Jersey. But now all of these, the DMV area there of Maryland. We've got some little stuff up here in the Boston area.
What's the Department of Motor Vehicles have to do with this?
Come on, buddy. Do you not know? You not know you're going to offend our Maryland viewers.
Bro, come on. Anyway, so yeah, no, I mean, again, the majority of the United States isn't offering these loans, right? I mean, it's in the areas that truly need it, which it is. It's a benefit. We've talked about in videos how in these markets you're likely to see, those that were kind of priced out at the top end of that budget probably get a little bit of buying power, which at the end of the day, it's hard to say whether or not it's really going to help just because of how, where home prices have gone. I mean, those homes that really, were in the 970 range a year ago or a year and a half ago, those properties now are probably $1.1 million. So it's what 970 what it got you a couple years ago definitely doesn't get you now. So
And think about it. What you're saying is the important part, Jeb. The geniuses that are writing articles with clickbait headlines about how this is terrible and signs of a housing bubble, that the government is buying these giant loans and they shouldn't be supporting $1 million purchases, don't understand that they're not adding an ounce of purchasing power to the market. They're restoring the purchasing power that middle class, upper middle class borrowers have lost in these super high cost areas. And as you can see, it's based off of the median home prices in those metropolitan statistical areas. So as they go up, we're going to see more areas get access to them. Like, to me, the amazing thing is the areas in the central part of the country, Utah, Idaho, Wyoming. You're like, that's nuts that we have places that tells you that the fact that they have access to high balance loans and never did before, that they've appreciated that much more than other areas. So it's interesting. It'll be interesting to see how it shakes out.
No, absolutely. And reiterate what I mentioned earlier. If you have questions about housing, real estate, mortgage, whatever it is, put them there. We'll get to them shortly. There's not really a lot in there at the moment. So I'm just gonna keep talking for a minute here. So I always update you guys locally on my market just to tell you what's going on. And I realize a lot of you don't care, but just to give you an idea of what inventory is doing, right? So as of today, coming on the show, 96 active properties here in Huntington Beach. The lowest number we've seen since the spring. And then also Orange County as a whole, 1,349 properties, 3.3 million people, 1,349 active properties on the market. Now, people think, well, that's homes. No, that's condos, that's townhomes, that's single family homes. That's also part of that includes luxury listings, which the majority of people can't afford. It also includes senior living, which unless you're 55 and older, you're not part of that demographic. So once you factor, actually affordable, and now I say affordable in air quotes because affordable is relative to where you are budget wise in our area of the country. But once you factor all that stuff in, I mean, you probably have, maybe couple hundred properties that are, within that under million, 1 million, 2 price point, which is, it's just insane. I mean, it really is. I mean, I have buyers looking for stuff and it's just tough. So anyway, that's my little stint on that.
Jeb,
Yeah.
those ultra low limited levels of supply, that leads to lower prices, right? We're going to have a correction because there's not enough homes. It's going to drop the prices, make it more
Yeah,
affordable.
that's it. Yeah, no, I mean, that's that, I keep seeing the headline crash. I keep seeing that things are going to go down. But then again, I saved an article the other day and I should have brought it on here. It talks about how, these markets are going to essentially not depreciate, but essentially aren't, what was the word they used? They didn't use crash, but essentially what it came down to is that homes are going to not be appreciating at the same rate they were last year. Therefore, it's a big negative on the market. And it's like, no, I mean, that's actually a positive for most of the market. The problem is they're trying to spin the headline to make it sound like it's more than it is. And the fact is, when you've got 19% appreciation year over year from October to October, September to September, whenever it was, going down in year over year appreciation, honestly, if you're a buyer, isn't a bad thing. That's a good thing. But yet the headline makes it sound like, oh my God, because it's not continuing to go up year over year, that there's some sort of big bad news coming. And we've talked about this many times. You can't continue to have that type of growth, that kind of growth, and it be a good thing, right? I mean, it's great for those that bought houses and what have you. But the reality is, if it continued like that, you really will see big problems in the future. But anyway,
compare it to this, like, Jeb, the word that they all like to use right now is, oh, the housing market is decelerating. Okay.
Yeah, and maybe that's the word they used. I did save the article, so maybe when you're talking here, I'll try to go pull it up.
Is that scary or is that a bad thing? No, compare it to when you're driving in your car. The last year, we've been driving our car too fast. 15%, 16%, 18% appreciation is driving your damn car too fast, dangerous, out of control. At a certain point, you have to decelerate. If you keep accelerating, you are going to crash. So that deceleration is necessary. The last time we were on here, we were talking about what are we looking at? What do we want that deceleration to look like? For me, in a perfect world, we would go all the way from the 16.8, depending on whose measure you use, somewhere between 15 and 18% appreciation this year. If we went all the way down to 5%, 4%, 6%, I would be thrilled. That's a sustainable level that people can deal with and can plan for. Think about this in the last year. We've had clients that will call, and it happens a lot here in the holiday season. Almost every conversation I have, hey, yeah, you know what, we want to buy, we want to see what we get qualified for. We're going to buy in March, we're going to buy in May, we want to buy sometime in the summer. Well, last year, if you did that, your $600,000 home went to $675,000 or $700,000, and you're paying that for the rest of your life. Some people got priced out of the market. Some people got pushed down to cheaper homes, priced out of neighborhoods and school districts that they liked. So there's no world in which any of us should be rooting for 18% home price appreciation or 12% or even 8%. 8% would double home prices in 9 years. We don't want home prices doubling in 9 years. They already outpace inflation. So there's a couple of pieces to this that everyone needs to understand. We talk about supply and demand. We also talk about the stimulus effect in that the government has to keep the cost of money cheap. When the cost of money is cheap, the people who have assets, it inflates the price of assets. So whether it's stocks, whether it's collectible cars, whether it's homes. So those that have get richer, and those that don't have a harder and harder time getting in. That's not cool. That's not sustainable. So we should all hope for massive deceleration, a 65% deceleration. And if and when that happens, the headlines are going to be blaring, oh my God, the housing market is screeching to a halt. And we'll be, no, it's normalizing to a level that's sustainable. If we had 5 years of 1% growth, 0% growth, still would be healthy and give us something that would normalize over the long haul. So when you're looking at the headlines and reaching that, the supply-demand imbalance is going to prevent us from seeing a decrease in home values anytime in the near future, but we want it to decelerate as much as possible so that it remains affordable for average homeowners.
Yeah, deceleration doesn't mean values are going down. It just means homes aren't appreciating at the same rate as they did the previous year or the previous term in which they're measuring. So just, clearly, I'm probably do a video on it at some point in the future when that gets posted, and we'll have that conversation. But, while I was here, Josh, you were talking, I looked up active properties here in Orange County, right? Again, 3.3 million people. That doesn't mean there's 3.3 million houses. It just means that's how many people live in the county, give or take. I looked at 3-bedroom, 2-bath homes, more than 1,200 square feet. And that's condos and single family homes under 1.2 million. And there are 291. And if you're looking at just single family homes, if you want a single family home, that's what, 215. So, and if you wanted a home under $750,000 in Orange County, you would have 21 options in the whole county. So not a lot to choose from. So let's get into some questions here. We got Jennifer coming in. Thank you, Jennifer, for being here. She's our moderator. She might kick you out if you're not nice, so be good to her. Solomon says, hey there. So, hey, Solomon. So here's a question. A blast from the past. Josh just keeps coming back, man. I don't like those blasts from the past. Who are you?
It could be a pleasant surprise. It could be a very, very
one of those skeletons
surprise
in my closet. What type of loan, if any, allows for more than a 45% debt to income ratio? So I feel like this is a good question.
Absolutely. It's a great question. Why don't we start with which ones almost absolutely do not? Jumbo loans, I'm not saying there's no jumbo lender out there that will go over 45. I have a handful that will do 45. Many of them are still sticking to 43. Some of them, depending on your qualifications, are even lower at about 38%. So now from there, nearly every type of loan can go above it. Doesn't mean that they will. So for Fannie Mae and Freddie Mac, we regularly see loan approvals up to 50%, but that is dependent on getting an automated approval. If you go with a manual underwrite, it's going to be lower than that. So if you can get an automated approval, which is a pure black box, meaning we can't look at the guidelines and say A plus B equals C and you can go to 50%. It has to like the file. And when we say like the file, what are the things it's looking at? Loan to value. The lower the loan to value, the more likely it is to allow you to go high. The more assets and reserves that you have, the higher your credit score. All of that stuff will allow you more flexibility in debt to income ratio. So Fannie and Freddie will both do it, but there is no guarantee. The higher your credit score, the better your reserves, the lower the loan to value, the more likely that is to happen. Now, FHA, again, it's in the automated system, and in general, a decently qualified FHA borrower is going to be able to go to a 47% debt to income or housing to income ratio and a 57% total debt to income ratio. So actually 46.99, 56.99. Now, if you have lower credit score, don't have any reserves, you're getting all your funds from a gift, there's things in there that even the FHA automated system doesn't like, then it's possible that you're going to get limited to a lower amount. Now, FHA with a manual underwrite, you can go all the way up to a 50%, but in that situation, you need some compensating factors. You need to have reserves after closing, a few other things along those lines. So FHA is a good possibility and much more likely than Fannie and Freddie to get you over 45. And if you happen to be a veteran, Jeb's going to start making jokes about how he turned off the sensors in his office so his lights won't go out on him. If you're lucky enough to be a veteran, VA loans are nuts. You can go all the way up to, but not
67.
all the way to. Jeb and I closed one at a 67. You can go to 69.99. I've never seen one over actually hit 70%, but you can get very, very close to 70%.
And I do not recommend that.
Yeah, you better. And what I always say, people hear that and they go, "Oh my God, these mortgage people are nuts. The market's going to crash." VA has a calculation that even if you were approved up to the 67, like our guy has, it's a residual income calculation. So they say, how many members are in your household? How big is the property that you're buying? What are the utilities? What are your other bills? Do you have child care expenses? And you have to have enough residual income after all your bills are paid that they feel like you can get by and live. So you do have to pass that self-sufficiency or the residual income test to be able to go to that high level. And it would be great if other programs did that because it works very well. VA loans, despite requiring no down payment and going to relatively low credit scores, have some of the lowest default rates. So from that perspective, you do have a number of options if you need to get over a 45% debt to income ratio.
Nah, good stuff. Jennifer came in, said she's finally been convinced to apply for a credit card because she had no credit. So welcome to the 21st century there, Jennifer, and credit cards and all the good stuff that comes with it. So let's see. Fabian is in orange and says that looking to buy next year, follow information closely. So yeah, reach out if you have any questions. San Diego, girly gamer. So how's San Diego going? So, I'm in Orange County. I don't follow San Diego like I do Orange County, but what I can tell you is that I do talk to a lot of agents in that market, one specifically that on a pretty regular basis, just because he refers me clients, I refer him clients, and the market is still full steam ahead. In fact, I had a gentleman reach out to me recently who was looking in North San Diego, and his price point was almost up to almost up to 3 million. And he's struggling finding anything in San Diego. And so he's now migrated a little bit further north and still looking for stuff. So inventory is still a problem. The market's still continuing to move. It's not going to change. San Diego is a big place. So depending on where you are in San Diego, it might be a little bit different, but overall inventory is a problem. Demand is still very high. The market continues to move full steam ahead. So not a lot of changing there. Now, my Dualor. Jeb and Josh recently bought a house in Wisconsin. Property tax is $5,175. Just received a letter from my lender saying that next year I'd have to pay more for my mortgage since property taxes are going up even more. Is there a way I can get my mortgage to stay constant? I got out of rent to prevent landlords from jumping rent on me year to year. Now it seems like the same thing with keep going. Two, just not as drastic. This really sucks. Then we found out our neighbor next door to us pays less. So yeah, so if you're outside of California, chances are your property taxes are going to adjust annually or every 2 years. Typically how it works here in California, it's a little bit different because of Prop 13. Now, what likely happened, and Josh can fill in the blanks here, is that you have impound accounts on your mortgage. What happened is your mortgage company got a copy of that tax bill. It shows that what you're paying into your impound account is actually less than what they need to pay those taxes when they're due, and therefore they have to up your monthly payment in order to cover those, so that they're not there's no shortfall at the end of the year. Not much you can do about that. And unfortunately, as property taxes continue to go up, you're going to see those adjustments. Now, Josh, did I miss anything? Anything you want to add to that?
No, dead right. Most likely that's what happened. We're 12 months in. Every year, your servicer, the person that you make your monthly mortgage payments to, has to do a reconciliation on your escrow impound account and make sure that they don't have too much or too little in your account. In this situation, you're telling us property taxes were increased, and they've run their analysis, and they're saying we're not going to have enough with your current payment to pay your property taxes next year. Now, this is one of the very few areas, especially when it comes to taxation, that California is a better situation. In California, we're limited to 2% annual increases, so this would be very, very minimal. In other states, when we get a housing boom and houses go up 10%, 15%, 20% in a year, your property taxes they don't necessarily will, but they can go up that much as well. So just kind of going back to your point of saying, hey, I bought because I want to be able to fix my housing cost, you absolutely fixed your principal and interest. Your mortgage payment with a 30-year fix is never going to change, but the payment for taxes and your insurance can go up. Ask people in Texas or in Florida when they get a hurricane come through and just destroy a bunch of houses. Their insurance goes through the roof. Same
Or here in
situation
Southern
with
California, you have a
fires.
fire.
Yep.
Yeah.
Yep. So those things can change, and you have to be aware and account for them. We don't truly have a 30-year fixed mortgage payment, PITI payment. We have a fixed principal and interest payment, but the taxes and insurance are going to change. And also be aware that your servicer every 12 months is going to do an analysis on this. And I've owned my current home for 18 years, always had a mortgage on it. We haven't paid it off yet. And I would say about 16 of those years, we've had a slight increase to our monthly payment, which is mind-boggling because we are in California. Our property taxes can only go up 2%. So, a couple $100 is all it can be. And some years they say, hey, we need an extra $70 this year for your mortgage. So it is somewhat amazing that the servicers can't get those numbers closer. One of the things to be aware of is they can require and maintain a cushion of at least 2 extra months of property taxes and homeowners insurance. So if they butcher that cushion, they can require a bigger amount to get themselves back to that cushion in a given year.
All right. Good stuff. That's good question. Good answer. Jay Finest. I have so many questions I want to ask you. Recently bought a house like 3 months ago, new construction, gained about 100,000 in equity, but want to buy a second home. Let's see here.
I got it. I got you.
Okay, there you go. How will the right method be, or what is the right method of acquiring a second property? If so, should I consider waiting for a pullback? If so, I fear that my equity may be depleted. So there's a couple of different things going on here. In order to buy the second property, sounds like you need the cash from your existing property since you're worried about the equity depleting in order to buy that property. So you've got to cash out, refinance, or some sort of bridge in order to get that property, which creates, not an issue in itself, but a whole different conversation. And then secondly, worry about home values declining. So what I would tell you about, thinking about investment property, or thinking about, buying a second home, I'm assuming when you say second property, maybe you're talking investing property versus, an actual second home. And what I would say is, if you're thinking about the investment standpoint, you've got to think from an investor mindset, right? Most investors aren't necessarily worried so much about the value unless, it depends, right? But majority of the time, they're worried about more cash flow. Like there's other strategies that go into that mindset, if you will, when thinking about that second property. So you got to figure out what it is you're trying to accomplish. If you're, here in California, it's going to be very tough to get, cash flow on a property unless you have a big chunk down. Most people invest in California because they want the appreciation. I have an investor here right now that's looking to buy property here. He understands that, with 25% down on a 1-2 or so purchase, he's probably going to be upside down a little bit with property taxes, insurance, all of that, but he's okay because he's in it for the appreciation game. He's in it for the long-term game. He's okay losing a couple $100 a month because at the end of the day, he thinks he wins with the appreciation. On the other side, if you're going into an in a cash flow standpoint, if it cash flows every month, who cares what the value does unless you have some sort of big plan that you're going to do something with that property in the short term. And Josh and I talk all the time. If your plan is short term in this market, you might be setting yourself up, not for failure, but for some setbacks. And not because we think the market's going to take some big dump or what have you, but you've had, probably in the last 2 years, 30% or so average in appreciation in a lot of markets out there. And to think that we can continue that, I think is a little crazy. So at some point, we're going to have some sideways pullback in pricing, and that might be a year or two out. But if you're thinking from the standpoint, hey, I buy it now, I sell it more in a couple of years, and I continue to do that, that's tough to get your mind around in a market that has appreciated so much. So I think you need to have that 5, 7, 10-year horizon, and you'll be in a much better situation and less worrisome about what happens over the next couple of years. Now, Josh, I'm sure you have quite a bit to add to that, so let's hear it.
No, the big thing, whenever I hear someone saying, hey, I fear that my equity may be depleted, should I consider waiting for a pullback? Jeb was dead on in what he's saying. What are your expectations? Why are you buying an additional property? Do you hope to get monthly cash flow? Are you hoping for appreciation? Are you hoping for a combination of those? How big of a down payment do you have to put into it? But if we're worried about a pullback related to our current value or that we may be entering at a high point, I'm concerned for that person stepping in as an investor, becoming a first-time investor, just because it's a risky market right now. I say this all the way across the board. You hear us. I don't think we're headed for a crash. I don't think home prices are decreasing. I think we're going to see more appreciation than we want this year. But there's still a yellow flag waving saying, caution. I say this, you guys probably get tired of the broken record saying, in 2010, I was screaming from the mountaintops telling everyone, buy real estate. These prices are absurd. They don't make sense. They're too low.
I live here. I never heard him say that.
He's a liar.
Never.
He's
never
a liar.
once.
I didn't talk to Jeb.
He didn't yell loud enough.
I didn't like Jeb in 2010, so I didn't talk to him. He was the guy that we would be at the gym and I would be on the rower ready to puke and he's cheering you on. He's that guy. So
that's great.
But just saying, at that point in time, you're telling everyone, buy, and no one wants to buy. Now we've seen 10 years of massive appreciation. Home prices have doubled, and everyone says, I want to buy more real estate. If you have a big down payment, if you have an in on a property that needs work, that you can build some equity into it and give yourself a cushion and it's going to cash flow. We've talked on the show here. I bought a home from a client back in the spring. The house had been destroyed, literally destroyed. It took us about $100,000 to put it back together. And I'm just looking at my numbers to put my permanent financing on it. We'll be about $400 cash flow positive. That's extremely rare because we bought a property at a very discounted price because of the distress. So just be super careful on your way in. The questions that you're asking tell me that you're nervous and possibly a little inexperienced at this, and there are some risks. So you need to be careful. I certainly wouldn't, just as Jeb said, I certainly wouldn't take on anything with significant negative cash flow and just pray for appreciation. We're probably going to get it, but there's no guarantee that it comes. And almost everyone that I talked to that's had a foreclosure or a short sale in the past, it was buying a rental property that they couldn't carry when the market dipped. They couldn't carry the negative cash flow, and they finally just had to let go.
Yeah. You summarize it in risk tolerance, right? What is your risk tolerance? What are you able to sustain if things go sideways? Again, that's not the expectation, but you got to think from that mindset. You can't always think that things are going to be perfect, especially, in the environment we're in. I mean, we're reaching high levels. Affordability is a problem. There are problems. But at the end of the day, supply and demand is what drives this. And so until that changes, you're not going to see many changes out there. Go ahead.
Jet,
You
before
got
we
something
even
on your
answer
mind.
the next question, I just
Yep.
want to say we're getting good questions tonight. These are all good questions, and the next two that you're going to hit are really, really good questions.
Bro, I might throw you off. I might not even click on
Go,
those.
curveball, throw it.
Dylan has a question. If you're self-employed and file as an S corp, can you submit a W-2 to a lender for approval, or do you have to submit business taxes too? So let's talk about what that actually means so everybody understands here. So as an S corp, you're a corporation, a pass-through corporation, but you're the owner of the corporation. You can pay yourself a salary. So you pay yourself a salary through that corporation. Then you're a W-2 employee, right? And so can I submit that W-2 to a lender and then not worry about anything else on my tax returns?
So no, and the loan application specifically asks, do you have an ownership interest in the company? So you say yes, and if it's more than 25%, we have to provide the tax returns. So you have to provide the tax return, and even if you didn't, the W-2. So here's sort of the thought. I almost wanted to say the W-2 is irrelevant, but it's not. When we analyze income for a self-employed borrower, the very first thing you do is you look at the W-2 income. Now you go and because that's and the reason why you do this is it's easy. You look at it and say, hey, there was $52,000 of W-2 income. Now we go to the tax return and we have to analyze. And why do we have to analyze that tax return? Because it's possible you paid yourself $52,000 W-2 and the business lost $500,000. So now we don't have $52,000 of income. We got negative $450,000 of income. Most likely. So
That's a good accountant, by the way.
it's a good accountant. As an example here, I just in refinancing the property in Orange, I had to just go through and analyze my 2020 tax returns, and then looking at that, we take the W-2 and then we go back through what was the K-1, what was distributed to me, and then there's some things that we can add back in there. You add back in depreciation. If you're in a type of industry where there's depletion, you add those back in, and then we have to look at meals and entertainment, and those get deducted out, and then you come to your actual bottom line figure. So really, the W-2 is less important than anything else because we're analyzing the total cash flow of the business. Like as an example, for 2021, I paid myself a bunch more W-2 than I did in 2020. So it doesn't matter because there's no 2021 tax return where an underwriter can analyze the cash flow. Because what if I had gone from last year, I paid myself $45,000 W-2. If I paid myself $450,000 this year, it could easily then take my business to a loss, which we don't know that because we don't have a tax return. So long answer to a fairly simple question is we have to have both. They're not going to just go off of your W-2 because they know you own the business.
Got it. There you go. Dressalanga. My mother-in-law wants to gift us $50,000 for down payment, but she's concerned she'll be taxed. Is this over the gift limit? So let's talk about gifts for a moment. Can you do them on any type of loan, Josh? Is there a limit on how much they can give you? And then is there a worry for the person that's actually giving the money with regards to taxes?
From a lender and loan program perspective, nearly all programs will allow gifts, even all gift. It used to be Fannie and Freddie required you to have 5% of your own funds. Now they're totally open to 100% gift. Jumbo programs, you start getting into limitations on either having to have some or all of your own funds. But the specific question here is, would she giving you money get taxed? And think about that. Just this is the easy way to explain it to her. She's giving you money. Why would she ever be taxed on giving away money? She could be concerned that you would be taxed on that money, but neither of them are accurate. We have our annual limits to an individual. So this is important here on this one. Jeb, do you know what the current annual limits are?
I don't. I could Google it real quick, but you could probably do the same thing. It's like 15,000. Is it 15?
I want to say it's 15, but my brain keeps saying that it's increased. It's 15. So
Okay,
in
yeah.
this situation, and you say my mother-in-law wants to give us, so I'm assuming that it's you and your wife, fiance, significant other. So she could give you $30,000, and that money disappears into the ether. There's no issue with that from a tax perspective. Now she's giving you 50,000. What happens to the additional $20,000 there? That amount has to be reported on her tax return. Doesn't mean that she's taxed on it. What it does is that's deducted from her lifetime gift exclusion, which is like $4.3 million. So $20,000 is like a teardrop in the ocean. Like no one's going to notice it. So in terms of gifting you any amount of money she wants, if she wants to give you $250,000, it's not going to have any negative repercussions. You're not going to get taxed on it. She's not going to get taxed on it. The excess above the $15,000 to each of you it will just come off the lifetime tax exclusion. And it's a common misconception that people worry and stress about. She's absolutely fine. And if you have questions, if she has questions, talk to her tax preparer. They can confirm that for you 100%. Shoot me an email. I can send you a link to an online article that confirms it. But again, experts online always verify. Trust, but verify. You get a CPA that's going to confirm that for you so that you know exactly 100%.
There you go. And talking about a blast from the past. So here we're also streaming to Facebook tonight, which I never do for whatever reason. So I decided to do it tonight. I just clicked on it. Dontrez Chapman. Wow, look at that name. He says 15.5 is the number. So 15.5, we'll go with that. Dontrez is coming up with this. And then he complimented me on my hair. So I thought it was worthy of clicking on that just because he complimented me on my hair. And I figured,
listen, I don't think Dontrez exists. I think this is your burner account over there on Facebook, and you're saying nice things to yourself while we're answering questions.
And then lastly, we'll say get around the lifetime gift by Utopian Giving, possibly trust. So put it in a trust, and for the most part, I think there isn't a limit on a trust too. But anyway, whole different conversation there. Dontrez, good to hear from you, my friend.
Dontrez, not only good to hear from you, it got my brain thinking here. Here's the benefit for you, Dre Salonga. We are here in December. So you got 2015 or 2021 and you got 2022. So you can get $30,000 here in December. You can get another $30,000 in January without impacting your mother-in-law or your mother-in-law's lifetime gift exemption at all. So you're fine. It's a good time of year to do this. So tell her to give you 30 grand now and give you the rest in January.
There you go. This is Jeb's burner account. Good to see you, man. So let's see here. We got a couple other questions. Was there any other questions that came off that? No, we just got some people commenting. Somebody did ask a moment ago. So Keith is following up to a question we had earlier. It says, if there's positive cash flow, is it still a good, or is it still a good buy still? And the answer is, again, it depends on your risk tolerance. What are you trying to accomplish by buying that property? Is it a long-term hold, positive cash flow? Who cares what the market does at the end of the day if you plan on holding it long-term, right? I mean, your grandparents that bought houses in the 60s and paid $15,000 for them, were mostly worried that they couldn't even make the payment. That they struggled making that payment. Now they own those properties, at least here in Southern California. Those homes are $2-3 million, some of these things. At the end of the day, the saying is what? Don't wait to buy real estate. Buy real estate and wait. Same is true for an investment property. I mean, you need to know why you're going into it and your plan, right? I mean, things do change over time. You might have a plan to be in there long term. Some things change and you need to do something that's unforeseen and not really a lot that you can do about it. But you still need to think through it. Don't just think you're going to buy real estate because, you're reading articles and things are appreciating and you just want to get a piece of the pie. Yeah, that's great. But, it's a more complex thought process than that. So just make sure you're putting some time into it.
So here, Jeb, another piece to say, if there's positive cash flow, is a good buy. Well, here's the thing. If I want to buy Jeb's house and I put 5% down, negative cash flow. If I put $700,000 down, I have positive cash flow. Is it enough to make it worth parting with $700,000? No. So you also have to say, okay, positive cash flow, but at what cost? So is it $100,000 and I get $100 positive cash flow? It's $1,200 in a year on my $100,000 investment. I'm getting a 1.2% yield plus whatever appreciation I'm getting. And if we have a mortgage, that cash flow doesn't include that part of the mortgage payment goes towards principal. So I'm paying the mortgage down. So there's a few moving parts there that you have to take into account. But for the most part, if you're confident that over the next 10, 15, 20 years, home prices are going to go up and rents aren't going to go down, if something has positive cash flow with a reasonable down payment, it's probably a decent investment for you to make.
Yeah, at the end of the day, like in the example Josh used, $700,000. What can you invest $700,000 on and possibly make a better return? That's what you get. Maybe Bitcoin, right? I mean, maybe you buy
Crypto.
Bitcoin. I mean, Josh had a client reach out to him today, wants to pull cash out of his property and potentially put it in Bitcoin. Josh had a conversation with him about the potential risk and what he loses. The guy's still okay with it. Like he's willing to take on that risk tolerance because of his plan. So the end of the day, you just got to know what your plan is. All right. Let's see. Are there any tips, suggestions to provide your buyers after they close on a home? Perks, savings, programs they can enroll or look up for being a new homeowner or for purchasing a new home? I don't know that there's really any tips or suggestions that are set in stone. I mean, I personally pay a little bit more on my mortgage every month. I'm in a position to do it, and it's not because I'm ultimately trying to pay my mortgage down, way faster. It's just I don't know. I add a little bit every month, and over time, it just continues to go down quicker. So, I mean, that's a way to almost like a forced savings, right? I mean, you're putting it towards your mortgage. It's going directly towards the principal, which at the end of the day, if you plan on owning that property long term, could be a good thing. If you plan on paying it off, it's probably even a better thing. But at the same time, money is really cheap, so paying extra every month may not make sense to you. I don't know if any other programs or ways to set aside outside of that. Josh, any thoughts on that question there?
No, the best advice that I can give to anyone is do not spend all of your money getting into the property and do not account for all of your money going to the monthly payment. Stuff happens. Even if you're handy and you do all of the work around your house, things break, things go wrong. There are people who will scare you and tell you, oh, you're going to have all these expenses. They're reasonable and manageable. Just don't go into it saying I'm going to spend every last dime on my down payment and closing costs. I'm going to put every spare dollar towards my monthly payment and have it work out. You just have to have a plan to have a contingency. And it all depends. If you're buying $1 million home, you probably need to make sure you have an extra $300-400 a month. If you're buying a $200,000 home, maybe $100 a month that you can put into your rainy day fund.
Yeah, all things to think about, right? I mean, what I found in my experience is that most people go out, they find out how much they can get approved for to buy a home. Let's just say we're talking to Josh. Josh says, "Hey, you can get a pre-approved for, $3,000 per month." And that equates to we're not going to use real life examples, but we're going to say that's a $500,000 home, right? So people go out and say, "Okay, I want to buy a $500,000 home." They come to me, "I want to buy 500,000." Then what they haven't factored in when talking to Josh, and what Josh doesn't factor in, is he doesn't factor in how much you pay in groceries, how much you pay in gas, how much you pay in childcare, how much you pay in all these ancillaries, because the lender doesn't they don't factor those in, right? What they're looking at is what's on your credit report, what's any child support, alimony, anything like that you pay, student loans, that sort of thing. They're not taking into account your true budget. And so as a home buyer, one thing you really need to figure out what your budget is so that you're not house poor. The worst, buying a house and having a nice house is great, but if every single, you know, extra dollar that you make every month goes in and keeps you able to go do things with your family and go out to eat or whatever, if you're okay with that, then okay. But either way, I think you're putting yourself in a predicament, because what happens if you do lose your job or something changes in the environment, another pandemic happens and you're not in a position to work or whatever it is. Just you need to factor these things in and have some sort of backing, because it's something, everybody wants what they want right now. And I can say I'm very much the same way. And when I want to buy something, I just want to buy it. I don't want to have to deal with it. But people take that into home buying, and it's a set up for disaster as far as I'm concerned, because you don't take into account all these other things. And unfortunately, there's no classes being taught on budgeting and or buying a home or whatever. But that's one thing that Josh and I, come next year, we are going to introduce a real first-time home buyer course, get you guys deep into this thing and help you understand the things that you need to understand when buying a house. And that's something that we're probably going to touch on, is really, how to set yourself up for success when you're starting that process. But that's a whole different conversation. Josh, let's address this one here. Actually, we'll go up to this one real quick because I feel like this was a quick one, and then we'll get back to that one. John says, current mortgage 3% fixed for 30 years. Will I be able to refinance? Will I ever be able to refinance for a lower rate? So we often talk about interest rates. Why don't we just talk about rates right now? Where are we right now? What do you see happening in the next, say, month? Because I feel like anything through the end of the year, right? Let's go there, and then maybe future for a long term. What you think?
Government loans are right now, FHA, VA, still under 3%, 2.75 range. If you want a lender credit, you may be pushing up to that 3 or low 3s. And most conventional loans are right at 3%. If you have lower credit score or you're taking cash out on a high balance loan, it can push up. I think the highest rate we have on a lock right now is like 3.375, and the lowest is probably 2.625, and that's most likely a government loan, FHA or VA there. So rates are still really, really good. But getting back to this question of saying a 3% fixed, are we ever going to have an opportunity? I absolutely believe that we're going to. So we go back, we talk about this probably every other show. Going back to 1982, basically Halloween of 1982, we've had a 40-year bull market in interest rates. So people pay more for bonds, yields, interest rates go down, and nothing has happened to break that. Just because we hit a new all-time low late last year, early this year, does not mean that we're not going to have an even lower low in the future. The example I like to give people is in 2013, we were in the middle of quantitative easing, government's buying mortgage bonds, rates go to a new all-time low. We had a day at that time where we probably, maybe a day, maybe a little bit more, we could lock a 30-year fix for the best qualified borrower, 0 points at 3.375. And people were like, that's it. We'll never have a lower interest rate than that. Well, flash forward 7 years, and we're in the middle of COVID. And on the best day we had, the best qualified borrower was locking in 2.5% with no cost, almost a full percent lower. Nothing has happened to change that long-term trend. So the trend is not a direct line down as we're seeing right now. Rates have popped up a little bit. We're up maybe 1/4 to 0.5% from where we were at the lows. But I fully expect they're going to continue to go lower. And there's tons of academic research that supports this, mainly saying that in industrialized economies, when government debt exceeds 100% of GDP, it decreases growth and GDP going forward, and therefore it's deflationary. So we are definitely in a deflationary environment. Our government went from $7 trillion to nearly $30 trillion of federal debt in about 11, 12 years. And it's going to have negative repercussions. I mean, there are people in Washington, D.C. that think we haven't had negative repercussions yet, so we've proven that we can just print money and do whatever we want, but it's coming. So what we're seeing right now, the big thing is everyone's worried about inflation. Well, we have artificial inflation right now because the government gave away a ton of money. So people, average Americans, people that didn't need it, a lot of people did need it and they needed it to get through COVID. A lot of people didn't need it and they got a bunch of money. So they're sitting on money, they're stuck at home, didn't have places to go spend it. So we were seeing, the New York Times ran an article today basically saying that the massive amounts of excess savings that we saw through COVID will basically be expended by next spring, basically back to normal levels. So what we're seeing happening is all of that excess savings is being spent now at a time when we have supply chain constraints. So it's hard to get things to market. So people selling things when there's a low supply are able to increase prices. We have a government, we have a president who came in and said, hey, anything that Trump did is bad. So we're going to reverse Keystone. We're going to get rid of all fossil fuels. And now we get to go pay $5 a gallon of gas. So those things are inflationary and you do see them. But the bigger long-term trend is absolutely deflationary. So the answer to your question is, are we going to get an ability to refinance at 2.5% next year? Probably not, but we're going to see a recession here in the next 2-3 years, and we're going to get lower interest rates than what we saw even at the bottom of the last cycle here.
All right, good stuff. Queens Bank, be a first-time home buyer, would like to buy a foreclosure or fixer-upper first and rebuild as a new construction. Is there a program for me in this economy? So first thing I want to address is going in with the mindset that you're going to, and this is not me ragging on you, this is just a question that we get often. So I feel like it should be addressed. And that's, if you are in this environment thinking that you're going to buy a foreclosure, I think you're going to be sadly mistaken, at least for a number of years. I mean, the majority of people out there, the amount of equity that's been gained over the last 2 years is substantial. And then even those that have purchased in the last 6 months have seen equity gains, in addition to them putting down payments, in addition to them paying down the principal during that period of time. So most people owe less on their properties than it's worth. Now, in the case that you do have foreclosures, you do have these homes coming to market, guess what your competition is? Your competition is people with cash, investors. Your competition is the Blackstones of the world, these big conglomerates that are sitting on piles of cash that have opportunities to buy these properties. And not to say, and I'm not this conspiracy theorist that thinks that every purchase out there is some big company buying property cash. I don't believe that at all. But what I can tell you here locally, every day, every single day, I get an email from some sort of investor type person that wants me to represent them to buy whatever property I find that could be a potential fix, a potential foreclosure, a potential opportunity to make money. So that's what you're up against. And not to say it can't be done, but it sounds to me you're telling me, is there a program out there that works for me? No, there's not. There's a program called cash, and that's the program that works when you're looking to buy properties for value in this market. Now, if things change in a number of years and there's a ton of them, a huge supply of foreclosures, inventories way up, supplies up, it changes to a buyer's market. At that point, there could be an opportunity. I don't see that happening. Everything that I just said, I don't see happening for quite some time. In my view, and my view is probably 3 years out, right? I think anything beyond that is a little crazy, and I might even say 2 years out. I don't see much changing on that front with regards to supply. Now, supply is going to increase, but is it going to be met with buyer demand? That's a whole different conversation to have. So to go back to your question, and then thinking about a rebuild, right? A rebuild requires cash. So if you're going in with the idea that you're going to do construction, that's tough unless you do some sort of FHA streamline or some sort of renovation loan that allows you to get into these properties and do the rehab through the loan. But even then, it's going to be tough to find deals in that, because if there's a true deal out there, it's likely to be met with quite a bit of buyer demand, just because of, that's what I'm seeing here locally. Unless you're in a completely different environment where, like Detroit was 7 or 8 years ago, you could buy a property for like $5,000, something like that. Buy a property, they'll give it to you if you pay the taxes on it. Yeah, there's those opportunities in some of those markets, but even that is, once in a lifetime type stuff. Josh, thoughts?
No, the example I always like to give is, again, this comes back to supply and demand. In 2008, 2009, 2010, when I was flipping a ton of homes, there were so many homes on the market, and many of them either distressed through neglect when people had financial problems, or literally beat up on the way out. Someone's getting foreclosed on, and they just destroy the house. So lots of properties needing a lot of work and not many buyers. So the average retail buyer would say, I'm going to go buy the nicest house in the neighborhood because it's on sale and there's no competition. So for investors like us, we were walking in and going, there's no one bidding on these properties. Literally the first few homes we bought, we had like 5 offers out and they would all get accepted. And we would have to go, wow, we didn't expect that. So let's figure which one we like the best. Now in the current market, if a property comes on the market and it's distressed, it's going to sell at a discount, but not a big enough discount. Like I can tell you, the property we just rehabbed in Orange, we paid twice what it would have cost in 2010. Now, some of that is normal inflation over 10 years. Materials cost more, but in the current market, contractors are up to their eyeballs. They have more jobs than they can handle. So they're not bidding aggressively. They're saying, here's the price at which I would be willing to do this. So a long way of saying there are construction and rehab loans. You do have to have some money. And for the most part, you're going to have a really hard time in the current market getting enough of a discount to make it make sense when you say, hey, for 3 to 6 months, I can't live in that property. I'm paying the mortgage and I'm paying the work to be done. So you really need a middle of the road market where it's neither a buyer or a seller's market, or preferably a buyer's market for those strategies to make sense. Now, all that being said, I just told you guys in June, I bought a house in Orange that made all the sense in the world. They're out there, but they're few and far between in the current market.
No, good stuff. So got a couple questions here. Renewal. I'll get to your question in a second. Try not to put questions, repetitive in here. It kind of bogs stuff down, makes things hard to find. But I got a question here that I actually don't know the answer to, and so I figured it'd be pretty easy to answer. So SB9, SB10, that's regarding California. It allows some, lot splitting, smaller properties to be built on the same lot as another property, can subdivide a lot, if you will, make a duplex out of what is a single family lot. And so the question is, does that supersede HOA policy? I've actually heard that it does. But I've also heard that it doesn't. And so I don't know the answer to that, right? So here in Southern California, like I just sold a home in a tract that had, it was built in like 63 and it had CC&Rs. For those of you who don't know, that's covenants, rules and regulations for like a community when it was built. And back then, the part of the CC&Rs said that that another property could never be built on that lot, right? And so since that time, you've had the state of California allow ADUs to be built, and now you've got the SB9 and SB10. And so I think those supersede those original CC&Rs of that community, which is essentially what HOAs have for the most part. So I think it does, but I think the HOA can then go back and alter the CC&Rs, and go against it. But honestly, I don't know the answer for that. It's something I need to truly dive into. And I'll try to do that because I think that's an important question, especially for people buying in communities that have HOAs that think that, hey, this could never happen. And then it could potentially happen. So I will get to that question. I'll make myself a note here when we dive into the next question and try to get that answer for you at some point in the future. So Renulfo, I can't even say that. Like my tongue doesn't go that way. Basically, doesn't it make sense? Pay my mortgage at 3%. He said it better in this one.
When inflation's at 5%.
Yeah, here you go. At 3%, compare with inflation at 5%. Doesn't it make sense to pay my mortgage using my cash? Is better getting a bigger loan and let it be inflated, don't you think? So basically he's asking, isn't it better to get a mortgage now at a lower interest rate, essentially let the property inflate in value because of all the stimulus out there and the inflation? Is that a better deal?
And Jeff, not just the property value. In a period of high inflation, future dollars are worth less. So you borrow as much as possible so you can pay it back in the future with less valuable dollars. So he is 250% correct with the fundamental understanding of it. So the question becomes, is inflation permanent or is inflation transitory? So we've had this big debate over the last year. The Fed used the term transitory. People lose their minds. Well, transitory means not permanent. So it's the accurate term. Inflation is not permanent. Think about this. I had this conversation with a couple of clients in the last few days. Up until from 2010 through 2021, the beginning of this year, the Fed tried everything it could to stimulate inflation, to get it up to their 2% mandate, and couldn't do it. And now we're at 5%. What's changed? What changed? What permanently changed is the bigger question. Nothing permanently changed. The government gave a ton of money away to households. Households didn't have anywhere to spend it. When the world finally opened up, they ran out to spend it. And because of all the COVID restrictions, we have all sorts of supply chain issues. So things cost more, and we have a lot of people chasing those finite goods. A limited supply of goods, an increased supply of demand based off of money that was given to them. That's not permanent. It's going to work its way through. We thought, if you go back and look at the shows that Jeb and I did earlier this year, we thought by the end of the year, early part of next year, and it's looking like it's going to be longer than that. It could be another year or two before they work their way through the system. But I will bet you everything I own that we are still in a deflationary environment. We are in an inflationary blip in a long-term deflationary environment. So while you are 100% correct in your understanding of the fundamentals, I wouldn't make bets in terms of taking out big loans thinking inflation is going to run for the long term and you're going to pay it back with cheaper dollars in the future.
There you go. Great answer. Queen's Bank comes back. I'm going to get to Dylan here in a second. If I qualify for FHA, could I use this on one of these properties? I'm in the suburbs of Virginia and we have plenty. So yes, you could use a 203K loan to buy a distressed property and use the loan itself to be able to get the money to rehab it. It's a process. It's not as easy as I'm making it sound here on this. I've actually done a video on it. You can search my channel and find it with regards to what a 203K is, how it works, how they use the current value versus the future value and get that amount of money to help you buy it. But the easy answer is yes, but it requires a more in-depth conversation of that. Dylan says, I want to buy a house. So he's following up. Earlier, he mentioned being an S Corp, having a W-2 salary. So now he's coming back and saying, if I want to buy a house in 2 years, I'm self-employed and file an S Corp, should I pay myself a large W-2 salary to qualify for the loan or continue paying myself a smaller W-2 for taxes? So there's a catch here, right? So you don't necessarily have to pay yourself a W-2 in order to qualify for that loan. You can pay yourself, through your K-1, a shareholder distribution. There's a lot of ways to get the money on your tax returns to be able to qualify for the loan. It doesn't have to come from the W-2 income. But what you can't have is you writing off all of your income and not showing any positive cash flow in order to be able to get that loan, right? I'm an S Corp, right? I pay myself a salary. Part of that is a small salary. And then I pay myself a shareholder distribution every month. Why do I do the shareholder distribution and not just pay myself all of that in W-2? Because I pay payroll taxes on that money that comes to the W-2. And there's a way that as an S Corp, pass through, I can pay myself the W-2, I can pay myself the shareholder distribution, and it still gets reported as income, but I don't pay the payroll taxes on it. So I'm not getting hit with that side of things. So talk to a CPA. I am not a CPA. I'm not an accountant. Let's make that clear. You need to talk to a tax advisor, somebody that can genuinely go through the numbers with you, help you understand them. We are just here for basic informational purposes only. But
Jeb,
Josh, thoughts on that question?
Yeah, on this one, he doesn't need a CPA because it's a mortgage qualifying question. And in the previous question, I wanted to start by saying the W-2 is irrelevant, and I backed away from it. But in the context of this, I'm going to reiterate: your W-2 is irrelevant. You have two piles of income. One is your K-1 distribution income, and one is your W-2. So if you add to the W-2, it's going to decrease the K-1 distribution. If you decrease the W-2, you're going to grow the K-1 distribution. So you have the same amount of qualifying income either way. Paying yourself extra W-2 is not magic. If you work for someone else and they give you a raise and your W-2 goes up, cool, that's extra money. If you give yourself a raise, it has to come from somewhere. It's coming from the cash flow of the business. There's less to distribute through the K-1 profit distribution at the end of the year. So stop thinking in terms of there's any way of manipulating payroll W-2. You have two piles. Until you add to both of those piles or add to one without decreasing the other, it's not going to do anything to help you qualify. The other things that Jeb said are 150% correct. You can write off all sorts of things. You can decrease your total income. You are required by law, by IRS guideline, to pay yourself through payroll. If you just always took distributions and never paid yourself a W-2, if you ever got audited, they will say you are attempting to avoid payroll taxes. Right. So that's where the CPA is going to get involved. But in terms of qualifying for the mortgage, taking money and decreasing your distribution, we're going to look at both. So that big W-2 as a self-employed person doesn't do anything if it's decreasing your K-1 distribution.
There you go. Thanks, Josh, for clarifying on that note. 200 people watching. I don't ask for a lot during the show, but I would ask that you do hit the like, subscribe, follow the channel if you don't already. Again, we put in 2 hours every Wednesday, typically every Wednesday, to help you guys get through guide you through the process, answering your questions. Really, nothing more that we ask for other than that. Maybe share with a friend. But other than that, I do appreciate you being here. So thank you for that. We'll get back to your questions now that I've done my 2-second stint there. And I will plug, Josh and I are working, I mentioned this earlier, on a first-time home buyer course. It's going to be good. We're going to provide content. We're going to do weekly lives that are just for those people to answer questions, to really get your questions answered. We'll have more information on it as we continue to figure out the details of it. But it'll be something else that you can share. Josh, good question here. So a minute ago, I mentioned FHA 203K, which allows you to purchase a home, and use money basically from the future value of that property to rehab it. We've got Keith coming in asking, can you do the same thing with conventional? So does conventional have the rehab loan? They do, but I don't know all the details on it. I know it's a home ready or whatever it's called, home style or something.
Fannie Mae has their home style renovation. It's a full suite of renovation loans. It varies in different ways from the FHA. In some ways, FHA is more flexible. In some ways, home style is. Like if you want to put in a pool, you can't do it with a 203K. You can do it with home style. So just depending on your qualifications and the condition of the property and what you're wanting to do with it, you have to go through it and see which of those two options is the best for you. I don't specialize in renovation loans. We've done them. They're not all that difficult. But if you're super interested in it, I've got a couple of buddies that this is all they do, and they are experts who can tell you exactly what the difference is between the two.
All right, good stuff. Another one that's pretty easy to answer here. Is there a first-time home buyer down payment assistance? Going back to saying Biden saying that he was going to do a $15,000 down payment assistance for first-time home buyers. I'm not going to say political stint, whatever, but at the end of the day, nothing's come to fruition from that. And there's a couple of reasons, right? I mean, if the market had a huge supply of homes and housing wasn't moving, you would have probably seen this come to light. But the reality is any additional stimulus to help home buyers at the moment wouldn't do anything. In fact, it would probably hurt the market more than it would help it. And so you're not likely to see any additional programs come at the moment for down payment assistance. But with that said, there are down payment assistance programs out there, depending on where you're located in the country. Different counties, different organizations have down payment assistance. So, find a local mortgage broker in your area. If you're truly considering purchasing a home at this point, or when you're ready to start that process, find out from them. Josh isn't going to know about first-time home buyer programs in Texas or Georgia or Florida. Usually you need somebody local that understands those and deals with them on a daily basis. Here in California, we really have one that's considered even somewhat of a down payment assistance. So if you're in California, there's one, he can help you there. But other than that, not a lot out there. Let's see. Josh,
Yep.
We'll go ahead.
We got one here that it's not really a question, but I like this discussion of where it goes. Ashley Wolf says, I bought in August. Glad I got in when I did. Absolutely. 100% happy with you got in when you did. So they get offers constantly in the mail to buy down my rate, but I'm not interested. The housing market is a circus. Jeb, you probably get this also, because as soon as a loan closes, the list buyers, they go out and the mailers are absurd. I get calls from clients that I've done multiple loans for, and they go, hey, I want to refi. I just got this thing in the mail. You're my guy, but this says I can get a 1.99 rate. So just sign me up. I'm ready to go. It blows my mind that the government doesn't do a better job because of policing this, because it's really easy. When a mailer shows up, it says who to contact, it says who it came from. They don't meet the guidelines for APR. The program actually has to exist if they put it in the mail. And Jeb's asked me a million times, hey, what does this look like? If someone wanted a 1.99 30-year fix, what is it? Well, it would cost them 11 points. So on a $400,000 loan, they'd have to pay $45,000. So even if someone was crazy enough to want to do it, there's laws of what you can pay for a loan, and there's no way to make that loan compliant with you paying $45,000 for an interest rate. So public service announcement for those of you who are homeowners, The people that are sending out mailers know nothing about you other than you bought in this time frame. They're going to pen data so they can get an idea of what your credit score looks like. Obviously, they know from when you bought and when your mortgage was recorded on your property that you may have X amount of equity in your home, but they don't know nearly enough to tell you an interest rate. So all they're doing is putting a rate on there to make you call and answer the phone, or make you call so they can answer the phone and then pitch you what they can actually do. Like one of my guys here, my loan partner, Russell, 10 years ago, he worked in a call center. And he said he was blown away. Like what they were sending out there, they wouldn't even let him know what the mailer was because you would be ashamed and embarrassed to answer the phone if you knew what the mailer was. So just whatever you do, don't ever answer a mailer.
And here's another thing I'll add to that. So Josh recently ran my credit because, looking at buying another property and doing some other things. So my credit got ran. So it showed an inquiry on my credit. And so now I start because they don't know if it's a refinance or a purchase or whatever. All they know is an inquiry got ran on whatever bureau or what have you. And so now I get things in the mail every day. And what I will tell you is that these things are so tricky to get you to call. And I mean, I'm in the business daily, understand the business. I know when this is garbage. So I would say it's a lot easier for me to look at them. But some of these things are really packaged they want you to call to have that conversation, to be able to, I wouldn't say trick you into doing it, but at the end of the day, it's almost like a bait and switch to some extent. I mean, some of these things come and look like FedEx packages. They come and look just, very catchy to the eye. What I would say, don't call those people. Work with a pro. I don't care. I mean, it doesn't matter whether you work with somebody, that we refer you to, somebody, friend, family, whatever it is, but just don't get caught up in that sort of thing because, those are typically the people that you don't want to work with.
If we went through the hierarchy of who you could or should work with, almost anyone in the mortgage industry would agree that the call centers that are carpet bombing people with mailers are the lowest rung on that ladder.
There you go. Let's see. I've seen so. I saw a question a minute ago. I'm trying to find it now. I can't. So videos galore. So it says, Jeb, do you plan on doing another video next year of comparing offers for your listings? Perhaps a compare contrast between 21 and 22 tactics buyers are implementing to win an offer. So the answer is yeah. I mean, I can do those videos if that's what you like to see, right? I thought it was a helpful video because everybody's talking about the market slowing down. Everybody's talking about, things changing and whatever. And yet I've got 2 properties on the market. If you haven't seen the video, I'm just kind of recapping what I do. I actually took the offers that we received, put them on a spreadsheet side by side, and showed you exactly what people offered. How many people went above the asking price? How many people, were putting 5% down, 10% down, 20% down, whatever it was. Did they waive contingencies? Did they not? That's helpful in the sense that you get an idea of exactly what people are doing. And not only do I do that, typically when we accept an offer on a property, I will now, this is something I've recently done, but I emailed the other offers, the other agents, and let them know, hey, look, this is what we accepted. This is what we accept. And the reason I do that is because right now I have buyers. I have buyers that are finding it very difficult to find property. We're going above. Oh, I got a good story here in a second. Going above the asking price and not making any traction and not figuring out why. Like we did a solid offer. Like, why aren't we getting accepted? And so I feel like it's helpful, like as an agent, to tell another agent, hey, listen, this is why you didn't get accepted. You were up against a cash offer that was $40,000 higher than you. That's why. I mean, if your buyer can't come to grips with that and be okay with it, then that's a whole different conversation. So, but here's what I want to tell you. So a client of mine is looking at buying a property, and Josh, you'll understand the story here in a minute. So I brought this story up some time ago, and now we've got the closing loop to it. So it's a property in Seal Beach, and it was in College Park West for anybody that's watching and understands the market. So it was a single level property in there. It was priced at like $950 or something. And so my client says, what should I offer? And I said, probably $1,030,000, right? There was one that had sold at like $1,025,000 or something like that. And I said, well, this one's similar. It's a single level. It's going to sell for at least that, right? He wanted to offer, I think we started at 975. He ended up countering back to 991. And I said, nah, I knew we weren't going to get any traction. Guess what? It ended up selling for $1,115,000. So it was almost $100,000 higher than what I thought he should offer. And he offered $50,000 less than what I thought he should. So just shows you how quickly things move and not understanding. And so to get to back to the original question, yes, I will continue to do those if you guys find them helpful, because I think they're good videos. I mean, I think that's some of the best content that I put out, quite frankly, because it's factual, it's real, it's there. It's not a theory. It's not my thoughts. This is what's happening. You can use it. So anyway, so if you like that stuff, comment on those videos and say you want more of it. I mean, I know you do now, but that's what's helpful in the future. So can't forget this ID. Get it? Took me a minute. It's like reading the license plate, man. Takes me a minute. As a first-time home buyer, would I be biting off more than I could chew if I use my FHA to purchase a 4-unit property? So, Josh, we've talked about investment property. We've talked about cash flow. We've talked about some different ways to buy homes. What are your thoughts on buying a 4-unit property, living in it, using the other 3 units to help maybe generate some income? Is that a strategy for investing? Is it potential to turn upside down? Like, what are your thoughts? What are those conversations you're having with buyers that are considering 4 units?
So I will say that one of my greatest regrets, I got in this business in 1996. I was 22 years old and didn't own a home, lived with my dad. So I was doing mortgages for other people and advising them on how to buy a home when I had never even done this myself, which we talk about kids in call centers in the same spot. But I wasn't the dumbest kid. I was fairly bright, and I looked around, and I had a client who was buying 4-unit buildings here in the Huntington Beach, Costa Mesa area, and we were in a down market, so they were actually cheap. You could get beat up fourplexes in undesirable areas for about 275 to 300,000. So I said, I'm going to get one of those before I get a house. So love the idea. Unfortunately, we found a beautiful condo a block from the beach, and we bought that, and we never got our fourplex. Those same fourplexes are now about $1.3 million, $1.4 million, and they're still a bad neighborhood, but they're worth about $1.3 million, $1.4 million. So long way of saying, if you can get into a 4-unit building as your first property, it's going to be the best and easiest way that you will ever be able to buy that type of investment property. If you buy a house and then go to get a 4-unit building, you're not going to be able to use FHA financing. You're going to be looking at a big 25% down payment. So I love the idea. We always want to throw out the caveat, depending on where you're at, there's an FHA guideline that most loan officers do not know about that will trip you up. For 3 to 4 unit buildings, FHA requires a self-sufficiency test. And it's a weird calculation because you're going to live in one of the units. But what they do is they take the rents from all 4 units, multiply them by 75%. That allows for a 25% maintenance and expense factor. And that 75% of the rent from all 4 units has to exceed the PITI. Now, in areas like Southern California, where the prices are really high, rents are high, but the prices are even higher, nothing passes that self-sufficiency test. So even though you're going FHA, you would have to put a bunch more down to be able to pass that self-sufficiency test. So from that perspective, it can be difficult. Now, if you're in other parts of the country where rents and prices are more in line and it works, absolutely, it's a great idea. So for those of you in Southern California where properties are not going to pass the self-sufficiency test or other high-cost areas, I'd say look at the duplex. It accomplishes largely the same thing, get you a nice investment property as your first home, and you don't have to worry about that self-sufficiency test. But yeah, you can absolutely use FHA, and I wouldn't say you're biting off more than you can chew. Just, we talked a little bit ago, the advice of saying making sure you're not using every last nickel you have and you have some money set aside, because with a fourplex, one of the problems, you could have a toilet go bad or the plumbing go bad in someone else's unit, and it's not an option to live with that problem. You have a tenant and they're going to expect that to be repaired. So just make sure you have a little bit more of a cushion than you would on your standard single family residence, that you're only responsible to yourself.
There you go. And I would argue that Josh said they were worth 1.3. I would say that probably minimum 1.5 in this market. Minimum. I don't think you can buy a fourplex. I don't think you can buy a fourplex any less than 1.5 anymore.
We saw one. There was over one that cited the Slater about 3 years ago, and a client was trying to get into it for $1.1 million, and I was like, that is nuts. Those things are $1.1 million, and now you're like, boy, I should have bought that thing for $1.1 million.
Yeah, and the market's gone up 30% since then. So, anyway, hindsight's a beautiful thing, isn't it? So Jennifer had a question. So if you do buy units, can you hire a management company? Or as a new investor, can the new investor hire a management company? So I'm assuming it's related to that. So you can hire a management company to manage the other 3 units if you don't want to, right?
Absolutely. And you're just going to pay for it. So it's going to decrease your cash flow. So if you're able to do it on your own, better from a money standpoint, for your peace of mind and peace and quiet, a property manager can be a really good thing.
All right. A couple questions here. Let's see. Calico 1404J. I wish you could get like the idea behind all this stuff. I just recently went into contract in a home in Beaumont. Each phase of the new construction will allegedly add $10,000 to $15,000. Can you have PMI removed off pure equity in the first year? So, Josh, question. Let's say they bought the house, home's appreciated more than 20%, or maybe you put 10% down, it's appreciated more than 10%. The pure gain in equity, is that enough to have that PMI removed?
So as a reminder, if you're using FHA financing, it's on there for the life of the loan. So in this instance, we're assuming we're talking about conventional financing. The lender can require you to have mortgage insurance for a minimum of 2 years to show a payment history before you can do an appraisal and petition to have it removed. And we actually had a couple of viewers here pipe up with their experience. Someone who, after 1 year, was able to petition their servicer and they removed it. Another one who about 18 months into it asked and the servicer said, nope, we're not doing anything until you hit that 2-year mark. So it's really going to come down to who your lender is and how they deal with it. It's possible. The other option is if rates cooperate, if rates stay the same or improve, you can always refinance and then the lender has no choice in the matter because you're replacing them with a new lender that would not require mortgage insurance. Now, currently we're seeing most of the people that bought 6-12 months ago, rates are a little bit higher. So most people are hesitant to walk away from their low rate just to get rid of the mortgage insurance, and rightfully so.
No, good stuff. Let's see what we got here. So, Jordan, I'll be getting 250,000 from a home sale to buy another home. Should I use all of that as a down payment? I have plenty in savings. So this comes down to a personal preference, right? I mean, how comfortable you are with the mortgage payment. If you put less down, are you comfortable with that payment? I'm a personal believer in leveraging as much as you can in this sort of thing, keeping that cash, in the bank. Cash is king, right? And maybe another opportunity, or maybe use that cash and put it in something that could potentially make you more money than what you're going to save per month. I mean, if putting an extra $50,000 down saves you $250 a month, but you can put that $50,000 into something else that's going to make you more than $250 a month, then to me, that's a better deal. But you've got to it's all about comfortability with your finances, right? Everybody's going to have a little bit different feeling on it. Dave Ramsey would tell you to pay down your mortgage, right? I mean, that's Dave Ramsey. He's clearly better off than I am. So maybe that's the better strategy, but I like the leverage approach to some extent, as long as you're comfortable with it. Josh, thoughts on that?
No, same thing. I would say cash is king and money is really cheap right now. So take as large of a mortgage as you are comfortable with. And that number is going to be different for Jeb and for me and for you. We would all look at the same situation slightly differently. So the mortgage advisor you're working with hopefully can show you 2 to 3 different options of different down payments and go with the biggest one that you're comfortable with. That may be the smallest loan, but whatever the biggest loan that you're comfortable with, it would be my advice.
No, good stuff. Let's see here. So Devin has a question. I just drank that Bang, and man, it was like first carbonated thing I think I've had in weeks. And now I'm over here burping.
Forget the carbonation. How are you doing caffeine at 6:30 at night?
Bro, that's the only thing I drink all day. Like I drink water all day. That just keeps me awake till 8 o'clock. If I didn't have that, I'd fall asleep.
I would be awake until tomorrow at 8 o'clock if I drank one of those right now.
I've also been up since 4 o'clock, bro. You were going into your second stage of sleep at that point.
Listen, no one wants your little humble brag about getting up at 2 a.m.
Here we go. So hey Jeb, bought a property in January of this year, gained nearly 100,000 in equity already. What would be the best and safest route using the equity to purchase my first investment property? So we had a similar question earlier. So Josh, if you want to get the equity out of your property, what's the easiest way to do it?
So I always want to look at this. How much money did you put down? A lot of our audience here is first-time buyers. Most first-time buyers don't have the benefit of a huge down payment because they're not selling another property. Some do, but most don't. So if you put 5% down on a property and it goes up 100,000 in value, we really don't have good cash out options above 80% loan to value. Whether it would be wise to do it or not, the options just don't really exist. So a lot of this comes down to value. If you bought a $500,000 property and you put 5% down, it's a $475,000 loan. So if it's gone up 100 in value, now there's $125,000 in equity on that $600,000 home. But at 80%, we got a $480,000 loan. You already have $475,000 loan on it. So it's hard to get cash out other than taking a second mortgage, a HELOC. Again, the whole purpose of buying investment property is generally to be a good investment and build cash flow. So even if we took that whole $100,000 out, use it as the down payment on a new $300,000 property. So we have a 35% down payment. We don't really, because we have the payment on that $100,000 that we took out of the current home. So all of that has to be figured into your cash flow analysis. And does it make sense to do it? At certain points in the market, in a rapidly appreciating market or a depressed market that's near the lows and is likely to appreciate for a long time in the future, that can make sense. But really, you got to look at your comfort level with cash flow and what you think is going to happen with appreciation going forward before taking on that risk.
All right. One of the more difficult questions we get here, Josh, every time, right? I mean, it's because everybody's plan is a little bit different. So, 25 years of sweet love and tears
Not
says,
sweet, not sweet, sweat, love, and
oh
tears,
man,
bro.
it was so much
No,
better with sweet,
no,
sweet
no.
love,
You're soft. You're
sweat
soft.
love.
Sweat,
I think
love,
I,
and tears.
oh man, I think it's sweet love. You see how I changed my radio voice? Kind
Yeah,
of a little creepy, huh?
a little bit.
Anyway, buy in 3 months or 1 year. Just sold my house thinking of renting till houses buckle. More thoughts. So, again, as a real estate agent, as just someone with common sense answering this question, it's difficult because we don't know what the market's going to do. But what we do know, supply is low, demand is still high, interest rates aren't really going to go anywhere or aren't going to go up enough to change the environment as a whole, right? So, question is, do you wait 3 months or do you wait a year? I personally believe home prices will be higher a year from now than they are at the moment. Now, what does that mean? Well, depending on where you are, real estate's local. So if you're here in Southern California, I would tell you that the quicker you could get in, I think the better off you'll be, as long as you have some sort of a long-term plan. Now, that doesn't mean I think that if you waited 2 years, you're going to be able to get a house cheaper. I mean, some of you guys have heard me say, if you've been watching this, I think the prices that you saw in 2018, I think I don't think you'll see those prices again in a lot of markets out there. I just don't know that homes are going to go back to that level. But who knows, right? I mean, so you've got to figure out what your plan is. What is your risk tolerance? How long are you going to be there? Are you comfortable with the payments? All the good stuff that we talk about. Now, if you're in an area where you're seeing a lot of supply on the market, things are changing, homes are selling for less, then maybe you wait a little bit. I don't know. You got to answer that for yourself. I don't think, waiting in Southern California is going to bring you lesser home prices. Maybe it brings you more inventory. If demand slows and inventory continues to rise, maybe it brings you an opportunity to get a better home for the same value, or maybe a little bit less on that property at some point in the future. Less appreciation, less rapid appreciation than what we're seeing. But I don't really have a solid answer for you either way. Again, I think if I were buying right now, I would try to be buying sooner rather than later. But that's me.
And Jeb, at risk of alienating our non-California audience, Sweat, Love, and Tears is in Victorville.
Sweet boy, we're going with sweet, man.
Sweat, no,
Sweet
no,
love.
no, they laughed you off. It's Sweat, Love, and Tears is in Victorville. So we've talked about this on the show. I have a really, really cool slide deck of a heat map from what happened in the mid 80s through the 90s in Southern California. And what it shows is that the inland areas, which Victorville's in the high desert, the inland areas appreciate the last. They can appreciate the most because the market's really hot. People are getting forced out there as prices go up, but then they are the first to struggle and suffer. So they're talking about wait until houses buckle. Well, we don't know when that's going to be. You and I aren't super worried about it being in the near term future, but it's coming to areas like Victorville before it does Orange County, LA County, coastal stuff. So it definitely changes that calculus. I'll just piggyback on what you were saying, Jeb, in that I think home prices, even in Victorville, are going to be higher this time next year. So if it's 4%, 5%, you're looking at a $400,000 home, that home's another $16,000. Not to mention that in that year, you would have made mortgage payments. You would have paid it down $10,000 or $12,000. So now you're $28,000 behind. So the market would have to correct 5, 6, 7% before you would ever get back to even. Plus, you're going to have to rent in the meantime. And some people are comfortable saying, hey, I have a cool house I'm selling. I'll go rent a cheaper apartment so they can save some money that way. Most people want something pretty similar to what they've been living in. We had a client think in terms of this, and they said, hey, we went out and looked at rentals, and they said, whoa, the rental prices are more absurd than the purchase prices. So I don't want any part of that. We're going to go ahead and buy now. So all that goes into the calculus. You're the only one that can answer that. And funny part, Jeb, here is Devin, whose question we just answered, is also in Victorville, and he followed up by saying he put 20% down. So the example we gave was if you put 5% down, property goes up 100,000, probably not in a position to be able to take cash out. He put 20% down, so he was already at 80%. So that 100,000 appreciation, we could do a cash out refinance and get that whole $100,000 and put it down on another property. So if there's homes for 300, 400, 450,000 in the Victorville area, you can put a nice down payment on a rental. So the numbers make a little bit more sense, or a little bit better, put you in a little better position than what we were guessing at without knowing where you were located and how much you had put down.
Yeah, I mean, it's crazy. So what I pay in my mortgage, if I wanted to rent something, you know, close to what I have now, in the same community, let's just go same community, same square footage, same everything, I would have to pay about 50%. Actually, I mean, if you include my property, everything, property taxes, everything on that, you'd have to pay about 50% more than my mortgage payment to get a similar property. And it probably wouldn't be similar. It would probably just be pretty, basic with regards to the property. So it's something you got to consider. And it's okay. If that's what you're okay with, that's okay. Like everybody's scenario story doesn't have to be the same. It's all about what you're comfortable with and how long you're waiting and what your plan is. But it's just things you need to factor in. Everybody just thinks, hey, I'm going to sell at a high price and I'm going to buy back at a low price, or I'm going to go rent something without ever truly seeing what does that actually mean, and so those are things you need to consider.
Well, here, Jeb, they're just giving us more follow up. It's like they're doling out additional info. So sweat,
Sweet.
not sweet. Sweat, love, and tears says bought at 267 and depreciated to 425. So I sold and I closed next week. Now, the thing that makes me think, Jeb, what do we always say? We say, I'm thinking about selling my house.
Do what?
Sell and do what? And
Rent,
that's the question you're asking. Do I rent or do I buy and wait for this market to buckle? I think that and again, so Devin had piped in saying, hey, Victorville's the Wild West. And it is, because it's so affordable. It's not far away from really high priced areas in Orange and LA County that people can look out there. Investors and potential first time buyers, they look at it and they go, it's so affordable. And they go out and they jack up prices even higher. So in the later stages of a boom market, I don't think you're going to be super happy if you wait this market out a year and rent. You're going to look and go, I should have stayed in my $425,000 house that's now worth 500. So hopefully you sold because there was something you didn't like about that house and you wanted to be into something different, better, whether horse property, land, 2-story to 1-story, whatever. Hopefully there was a reason why you left that property, not just excited that there was $150,000 of profit, because you still have to live somewhere. So for what it's worth, hopefully we answered the question.
Yeah, good stuff. Sweet love. Johnny Stash says, put an offer on a house, waive loan contingency, have stable employment, excellent credit in DTI. Should I be worried about getting my loan denied? What happens if loan is denied after accepted offer? So let's talk about this for a moment. So, if I were advising a client putting in an offer, if we were talking about waiving the loan contingency, what we would do is we would confirm with the mortgage professional that they're working with that their loan is rock solid, right? You've reviewed their tax returns, you've looked at their credit, you've seen their down payment, you've dotted I's, crossed T's. If there's any questions, it's been to an underwriter. That loan's going to be approved so that there is no question, right? If that's not the case, then don't waive loan contingency. Now, there's always the chance that you waive the loan contingency and something happens with employment, something happens with your credit, something happens unforeseen that you had no idea that could happen. That could happen in any scenario. So that's unpreventable. But what you can do is, the things that are, what's the right word? Questionable, so to speak, with regards to income, the original qualifications. As long as you've done that, then I think, I waive loan contingencies occasionally with buyers that are rock solid. They have a lot of money in the bank. They have great jobs. They're good to go. Low DTIs. Sure. Just helps them stand out a little bit more. But now to answer your question, what happens if the loan's denied? Well, essentially you can't use that contingency to back out. Now, in some states, they give you till 28 days, right? Arizona, I think 28 days loan contingency. So if you had that contingency in place, you could go all the way up to the end of that loan, not really have any issues. You'd pretty much be certain that you were going to close. Here in California, people waiving it, doing shorter terms on the contingencies. So there's a lot going on there. So you just got to make sure it's the right deal for you. Other than that, if you're a solid buyer, which there's a lot of people out there that are, shouldn't be a big deal.
The thing that I would say on that, so what does he say? I have stable employment. I have great credit. My DTI is wonderful. I have never had a client declined that we didn't know that the decline might be coming. So we put hairy loans together and put them through all the time. But you and I would have had a conversation of saying, hey, A, B, and C are awesome about your file. D is a little bit of a gray area. Here's how and why we think we're going to get it through, but there's no guarantee here. And we would never tell you to waive a loan contingency on that. So if the lender that you're working with, I'm assuming you asked them, said, hey, I'm comfortable with that. We have clients all the time that I look at and I go, there is no world in which you don't qualify for this loan. I have a guy right now that literally I spent the day that they got their offer accepted after a year of looking for homes, spent hour and a half across 3 phone calls, and they're just asking, what can go wrong? What happens if we get declined? How do we, what would, and I'm like, dude, I've never had a loan declined for a well-approved, a well-qualified client. It doesn't happen. When it happens, we know it's coming. We know there's a potential, and even that's very rare. We got an approval today that one of my loan partners and I, we went through it and we beat it up 6 ways to Sunday. We said, here's how we want to present this file to an underwriter, and we like our chances. It's about an 80% chance of it going through. This is a refi. It's not a purchase. There's not a seller on the other side at risk here, but we knew there was a 1 in 5 chance it gets declined, but we did everything possible and we got it through. And that generally happens. It's very, very rare that we get a loan declined, but when we do, it's not out of the blue. And in this situation, I would assume that your lender's in the same boat. They're like, oh, dude, you're super well qualified. There's nothing to worry about here.
All right. Cream Disco. Bought a property in February in an extremely competitive market here in Maryland. What do you think about letters to sellers, which I feel helped me close the deal for my house and differentiate myself. I think they're good. You got to find out. Like some states, Oregon, they're outlawed. Here in the state of California now, there's something on the actual listing agreement that basically says, as as a seller signs it, hey, do you want me to give you the letters that buyers submit as part of the deal? Check, basically yes or no. And if they say yes, then it's okay to give them. If not, then essentially I'm not supposed to send them to them as part of the offer. So I definitely, buying a home is an emotional process. Selling a home is an emotional process. If you can tie into that emotion to the seller, I think it gives you a better opportunity. But that's also part of the reason they don't want them, is because you're making emotional decisions versus factual decisions. So you might choose a family over a single person because they're a family, which in theory is, what's the word I'm looking for here, Josh? Not profiling,
Discriminatory.
but
Discriminatory.
discriminatory. Yeah, being discriminating against, if you will, because they're not a family. So if your realtor's okay, you doing the seller's okay receiving them, fantastic. Do it. Tell something about yourself, what you liked about the property, and stand out. It's nothing wrong with it for sure. Let's see. I did see another question here that I wanted. So Kink Shep. That's a Q, right? Yep. How to refinance out of an FHA. So, Josh, I have an FHA loan, want to refinance and get out of FHA. Typical refinance process, right?
Yep, no different than any other refinance. If you go from FHA to FHA, you have the option of doing a streamline, which means no appraisal, no income documentation. If we're going from FHA to conventional to get away from the monthly mortgage insurance, then you're going to have to go full qualifying. You still may be able to get an appraisal waiver in some circumstances, but nothing different about this than any other full qualifying, full doc refinance.
All right, good stuff there. See anything? So G Dirt, we kind of addressed this question earlier. Would you buy your forever home right now or wait it out? Portland, Oregon, 10% down. If your forever home, why do you care? Like that's what like if it's your forever home, why do you care what the value is in a year or 2 years or 3 years for that matter? Yeah. Ideally, we all want to buy at the bottom, sell at the top. But if it's your forever home, chances are you're going to have it forever, right? Which means that who cares what it's really worth at the end of the day? You got to live there. You got to be comfortable with the payment. That's what makes sense. I wouldn't personally, if I was looking for my forever, if I could buy my forever home right now, I'd be all over that. Because I think, I'm years away from being able to do that. And by the time I'm able to do that, that home's going to be substantially more expensive than it is now. So that's, if you've already determined where you're going to be, the type of property you want to buy, it's forever. So I think that says it all as far as I'm concerned.
And Jeb, that brings up another point here, and it kind of goes back to sweet love and tears.
Sweet love.
If you're a homeowner and you plan to continue being a homeowner, stop worrying about if the market's at a peak, if it's going to go higher, if it's going to go lower. If you own a home and you intend to own a similar home, slight downsize, slight upsize, if you own a $500,000 home and you're thinking of buying $1 million home, I get worrying about whether we're timing it. But if you own a $500,000 home, you want to move up to a $600,000 home or down to a $400,000 home, you're a homeowner. You want to continue to be a homeowner. You want to pay off your mortgage over time so that you arrive at retirement without a mortgage payment. It doesn't matter. This stuff doesn't matter. The people who are here and should be asking these questions are, should I buy my first home in this market? And we've answered it 1,000 times. I believe that the market has more room to run. We still are going to have stimulus in terms of low interest rates. We have a lot of people that can qualify. We don't have a lot of homes. We're talking an 8 to 10 year timeline at best before builders could build enough homes to close the gap of the home supply that we need. Now, that doesn't mean that that's the same for every area. Now, remember, Jeb and I are biased to our local market. And by local, I mean all the way throughout the state of California. I don't know of anywhere in California, and again, we've talked about this before, you get much north of the Bay Area, and that's like another state up there. But the populous parts of California, there's just not enough homes, and we're not going to fix that imbalance anytime soon. So know your market and know your area. But if you are a homeowner and want to continue being a homeowner, do what you want to do. Move to a different home. But stepping out and trying to time the market, none of you are smart enough to know when to sell the home and when to buy back in. Nearly every person I know that has ever done that has ended up on the wrong side of it. I know a couple of people who are very astute investors, and were not playing with their residences. They were playing with their investment portfolios, and they've timed the market very successfully. Not perfectly, but very successfully. So for what it's worth, if you want to own a home, own a home. We're nowhere near being at some sort of peak that puts you at risk. We saw a headline a few weeks ago. Ivy Zellman, who's one of the leading, if not the leading housing analysts in the United States, saying the clickbait headlines that the news aggregators pulled out was that she was saying that she wouldn't buy right now. Wait. And then you watch and see interviews with her and people asking her questions. She's saying the same things we're saying. It's definitely a yellow flag. You want to look at the market and you want to look at where you're at. She's talking about a lot of the areas in the Midwest, in the South, where there is a lot of building going on and there's a lot of open land where builders can build more homes. In populous areas that are completely built out, there's not a lot of risk here of home prices decreasing in the near term. And more likely, we're going to see more of the same.
No, absolutely. Couple things here. So Shonda has a comment, and I want to read it because this is why we create the channel, right? It's not to tell you to buy a home. It's not to tell you to sell a home. It's to give you information so that you can make informed decisions, logical decisions on your behalf because you've thought through the process, because you've done your thing, right? So just want to thank you guys. Placed an offer under asking, seller paying closing costs, got it accepted. Thanks to you. Was able to look at an area and market, decide what to offer. So again, don't know Shonda, don't know the market, but again, that's what it's about, right? That's why we spend time here doing this every week. And it's not a toot of my horn. I don't care about that. What I do like is the fact that we're able to help somebody, build wealth long term. And that's really what it is. So congrats to you, Shonda. Appreciate it. No, nice comment. So I saw another one here, or actually two more. There's a couple here, Josh, that we kind of finish up on. Turo man purchased a home in 2020 at 420, worth around 600 now. 3-part question: how can I get the FHA insurance off? We've talked about this. Can I refinance taking some money out? Should I stay FHA or go conventional? So $180,000 of equity at this point, which is quite a bit during that time period. So what, refinance in order to because it's FHA, you bought it in 2020. It's been over a year, potentially two coming up, depending on when you purchased it in 2020. So can you do another FHA loan to streamline? How does that work with taking cash out? Kind of let's help them out real quick.
So yeah, a streamline would basically be to just get a lower interest rate on an FHA. Depending on when you bought in 2020, interest rates are probably pretty similar to where you were then. So the big potential savings is to switch over to conventional and get rid of the mortgage insurance. And in terms of taking some cash out, is almost the exact example we threw out to Devin. If the property's worth $600,000, you can go up to 80% cash out. That puts you at 480. It's about $60,000 there. That's going to have the worst terms because it's the highest loan to value cash out. It's going to be a little bit better if you stay at 75 or 70, but 70 puts you at 420 where you're at right now. 75 might be a nice compromise. So yeah, you should be able to get rid of your mortgage insurance for sure. You should be able to get some cash back. The only reason you would want to go FHA is if the scores are lower enough that you would be paying a higher interest rate than the FHA rate plus mortgage insurance. So most likely it's a conventional loan. So it's funny, Jeb and I were having a conversation before we came on here that really 6 months ago, we were still doing a lot of rate and term refinances. Someone bought, they got a 3.5% interest rate, they want a 3% or a 2.75. What we're seeing here is all you guys are looking at, I have a bunch of equity in my home. What can I do with it? Is it invest in another property? Is it pay off some student loans? Is it pay off some other high interest rate debt? And the cash out is the real opportunity right now. And when I say cash out, A lot of people in 2004, 2005, 2006 got themselves in trouble because they wanted to extract every nickel out of their house and buy frivolous things with it. Don't do that. Use this opportunity to set yourself up for the future. It can make sense to take cash out of the home, but let's pay off high interest consumer debt, not so that we can go take on more, not that we can go buy a boat, but invest in some crypto, invest in additional real estate. So there's a bunch of you in here that are saying the same thing. Hey, my home's gone up a ton and I want to get some equity out of it. That can make sense. It gives you an opportunity, but it's just cash out, refinance, and do what? Let's make sure we're doing smart things with it and adding to your financial future and not just burning the equity that the market has benefited you with.
No, good stuff. So we got a lot of good questions here, Josh. We got about 10 minutes or so. Let's try to knock a couple of these out real quick if we can. Armando says, do we think the aging population of baby boomers will lead to an increase in supply? Keep in mind, this is the same generation that is retiring away, is leaving many job openings unfulfilled. So here's what I'll say is a lot of people thought that the baby boomers were going to retire and sell their properties and downsize, and that was going to add to the supply of the market. We haven't seen that because there's a number of reasons. One is baby boomers are actually living longer than they were when, you know, this whole conclusion originally came about. So people are living longer, staying in their properties longer. It's now more expensive if they want to sell their property and buy something else. It's, you know, chances are they're paying more money or as much money for the downgrade in many markets as they would be just staying in their current property. So they've, you know, taking that into consideration. And also these people, keep in mind, supply is very low, right? They have a property, they have to go somewhere. So that means it's a 1-for-1 deal. They sell their property and they buy something else, or they go into retirement communities or whatever. But typically if somebody's selling something, you know, even baby boomers are buying something else or whatever. So it's a 1-for-1 exchange. That means they sell one, they buy one. So there's no new inventory added to the market because it's basically gone, right? So it doesn't really help in that sense. Now, at some point, boomers will age out, property will come to the market, but we see a lot of wealth being transferred. You know, those baby boomers aren't necessarily selling. They're passing it along to kids. They're giving it to family members who are deciding to keep the property, rent it out, keep the property, live in it because they can't afford a house. Now I'm just going to take it over. So you don't know the true intentions of, you know, boomers when they do pass on what happens to that property. Yes, some of it will come to market, but how much of it and when, hard to say, right? I mean, the biggest fuel to the home buying scenario at the moment is millennials, and it has been for a couple of years because of prime buying age. And so they are still continuing to hit that prime buying age number, and will for the next couple of years. And so, you know, the typically those millennials are buying the properties that, you know, the first time home buyers had, and the first time home buyers are buying those properties, the move up properties that maybe boomers have or whatever, but it's continuing to transfer upward. So I don't know that it's going to create a, you know, a lot of opportunity, but there's always that chance. Let's
Well,
see
think
here.
about it, Jeb. The piece that you hit on there that's really important. What Armando's really asking about is, are boomers going to, either through death or selling, create additional supply? And the answer is no, because the boomers are outnumbered by millennials. Millennials are coming into the age. So we got 74 million millennials, and the boomers through death. I mean, boomers in 2019 were at the same level, 72 million. So there were 72 million millennials, 72 million boomers, and now we're down much lower in terms of where the boomers are at and where they're projected to be. So right, you know, by 2028, there's 64 million. So just long way of saying millennials are going to absorb that additional supply because it has to happen. I mean, really, they behaviorally millennials or boomers didn't decide to sell and add the supply, but they can't outrun death. Eventually they're going to die, but the way things work is we also have another big generation coming behind them that will absorb that supply.
No, good stuff. King Shep, you know, asking question for the third time. If you ask the question, you should probably stick around for the answer. It was answered, what, I don't know, 5 minutes ago. So go back, rewind, watch it. It's there. Yeah, that's a note to everyone. Hey, if you want your question answered, stick around. We usually get to them. We've answered, I think, every question in here for the most part. Here's a good one, Josh. Want to refinance my home and cash out 150,000 for a rental. Co-borrower with my brother's house. He just came off COVID forbearance. How can I refinance? He doesn't have 12 months that he's made of payments to exclude it. So when you co-borrower on a loan, for example, Josh is buying a house. I'm a co-borrower for him. And I want to go out and get my own loan. The lender doing my loan for the new loan wants to see that the other borrower has made payments for 12 consecutive months in order for that not to be considered my debt. Is that still accurate out there at the moment? And is there a way around that, Josh?
Yeah, and for those of you that watch here every week, it's not often we get stumped. I have not had this one come up, and I kind of think you are stuck. But Con, if you can, Jeb, throw up our email addresses. Shoot one or both of us an email. I'll get you an answer on this. I have several underwriters at my disposal that we can go through and beat up that question and find out if there is a good answer. I don't think that there is. I think we're going to have to hit you with both payments because we don't have that 12-month payment history. But I may be
I
unaware
don't
of
even.
some
Oh, I
guidance
was
from
okay.
Fannie and Freddie about forbearance that would allow us to work around that. So there's our email addresses. Shoot one or both of us an email. I'll get you an answer on that because I don't know of any way around it.
All right, that was good. Let's see here. We're finalizing, getting towards the end here, guys. 2 hours. If you found any value, we answered your question. Anything, hit the like button, hit the thumbs down if you think we suck. It's all good.
Jeb, I want to
Yep,
answer this one. It's
yep.
not even really a question here. Tube Light says I bought for 540,000 a year ago. I'm paying 1,000 in principal, 1,000 in HOA, 1,000 in interest, and 650 in taxes. I'm worried that the appreciation would never catch up with the money spent. You have to realize a house isn't free. There's a cost to the shelter. So you are going to pay to live there. There's interest, there's taxes, there's insurance. That's the cost of living there. The principal is a savings account. That $1,000 a month, you're putting it in a savings account. It accrues to your benefit. Someday you can sell that house, you can refinance, you can borrow, you can pull it out. But let's say you weren't owning, you don't get to rent for free either. So we can't make a housing payment go away by not owning the home. You either can pay a mortgage or you can pay the rent. So if you're looking at appreciation, making it free to own a home, that's just never going to happen.
No, good stuff. And $1,000 for an HOA, that better be a hell of a property you're
It better
living
be
in.
sweet. It might be a high rise. The high
Yeah, it's
rises
got to
are
be a high
ugly like
rise.
that.
And there's no way otherwise. I mean, that's but part of that HOA, again, if you lived in a single family home, at some point you're going to have to paint the exterior. You're going to have to replace the roof. You're going to have to maybe fix the HVAC, all of that stuff. Whereas in an HOA, maybe that's taken care of. So that's part of your expenses as well. So you got to weigh all of these things. It's not black and white always, right? There is some gray area in the middle where you've got to figure out, hey, yes, maybe it's costing me a little bit more, but this is the alternative to refinancing or being able to get ahead, right? I mean, we talk about this all the time. Homeowners have a 44 times greater net worth than those of renters. Why? Because of property appreciation, because of the forced savings of paying down that principal balance over the long term. That's how they get it. It's not, a magic formula. It's pretty simple at the end of the day. And so, just keep that in mind. Let's see here. We are at 2 hours. So guys, I'm going to ask one more time. If you haven't, hit the thumbs up. If you found any value, that thing right there, you can't see me waving my cursor on it, but I promise I'm like putting it on there. I'm pushing it. So do that for me. If you have any questions, you can leave them in the comments below. A lot of the stuff makes good content, guys, and we appreciate you being here. Appreciate all the support. Josh, any final departing words you want to add?
I got a question for you, Jeb. Do you have one of these fancy graphics for your referral form? We got a lot of people talking here about tapping their equity. And if you use Jeb's referral form for a loan or for a realtor, he's got a big network
There you go.
everywhere. If you're in California, that referral link will get you to me on the mortgage side. If you're in any of the other 49 states, Jeb has people that are almost as awesome that he'll get you connected with. And I will say on the cash out stuff, that is the biggest area for refinances right now. And it's much easier to not necessarily bamboozle someone, but not position them optimally in the mortgage. So make sure you're dealing not with a call center, not with someone that sent a mailer out to your house. Deal with an expert, and Jeb can help you get connected with someone from that end.
There you go, guys. We'll be back next Wednesday, 2 hours, live at 5. We appreciate you being here. Thanks again. Adios.